Have you ever wondered why the world feels like it's shifting beneath our feet? Well, what we're witnessing right now isn't just political chaos or economic turbulence. We're actually living through the most significant restructuring of global power since World War II. And the evidence is everywhere if you know where to look. At the recent World Economic Forum in Switzerland, the world's most powerful people didn't just admit that globalization has failed. They openly discussed how to divide power in what they're calling the New World Order. This isn't conspiracy theory talk anymore. This is happening right now in broad daylight with real numbers and verifiable events backing it up. Hi, I'm here to break down exactly what's happening, who the real players are, and what this means for your future. Because understanding this shift isn't just interesting, it's essential for navigating what comes next. Let me start with something concrete. For the past 80 years, the world has operated under a very specific system. After World War II, the global powers carved up responsibilities like a massive corporate structure. China became the world's factory, producing goods at scale. Japan became the lender, keeping interest rates near zero to maintain global liquidity. Europe became the primary consumer market, trading military independence for social welfare systems. And the United States became the enforcer, backing the entire system with military power and the petrodollar. This system worked through what we can call a proof of weapons network. Countries that wanted to trade or access capital had to follow two simple rules. First, use dollars to buy energy. Second, don't mess with U.S. interests. The petrodollar arrangement ensured global demand for dollars because everyone needed them to purchase oil and gas. The military enforced compliance, and financial institutions managed the money flows. If you played by these rules, you got access to investment markets and military protection. Break the rules, and you faced sanctions or worse. For Americans, depending on your economic position, you either benefited tremendously from the system through corporate profits and investment returns, or you watched your manufacturing jobs disappear overseas as companies chased cheaper labor. But here's where the numbers tell the real story. This system required perpetual military engagement to maintain credibility. The defense budget consistently consumed hundreds of billions annually, not for direct threats, but to maintain global dominance. Manufacturing employment in the United States dropped from over 19 million jobs in 1979 to around 12 million by 2010, even as the population grew significantly. The system created massive wealth concentration. The top 1% of Americans saw their share of total wealth increase from about 23% in 1978 to over 32% by 2020. Meanwhile, real wages for middle-class workers remained essentially flat for decades when adjusted for inflation. Now, fast forward to today, and the foundation of this system is cracking. Multiple nations have formed alternative arrangements that bypass dollar-denominated trade. China and Russia conduct bilateral trade in yuan and rubles. The BRICS nations, representing over 40% of global population, are actively developing alternative payment systems. Japan, historically the system's chief financier, is being forced to repatriate capital. They've been selling U.S. Treasury holdings, reducing their position from over $1.3 trillion in 2019 to under $1.1 trillion by 2024. This matters because the dollar system requires perpetual demand, and that demand is measurably declining. Europe learned harsh lessons about dependency during the energy crisis following geopolitical tensions with Russia. Natural gas prices spiked over 400% at their peak, demonstrating the vulnerability of outsourcing energy security. Industrial production fell as energy costs became prohibitive for many manufacturers. These aren't abstract concepts. These are measurable economic shifts that signal the end of the post-World War II arrangement. The proof of weapons network can no longer enforce compliance without risking global conflict that nobody wants. So who are the actual power players reshaping the system? There are four distinct groups, each with different motivations and capabilities. The first group consists of financial globalists, often called transnational capital. These entities don't pledge allegiance to any particular nation. They are essentially stateless capital seeking optimal returns, regardless of geography. At the apex of this structure sit three massive asset management firms. BlackRock, Vanguard, and State Street collectively manage over $20 trillion in assets. That's roughly equivalent to the entire U.S. gross domestic product. Their power comes from a simple but profound mechanism. They control voting rights for the shares they manage on behalf of clients. Here's how this works in practice. When you invest in mutual funds or exchange-traded funds through these companies, you typically don't exercise voting rights for individual companies within those funds. The asset managers vote instead. According to BlackRock's own data from 2025, out of $7.4 trillion in total index equity, only $3.65 trillion was eligible for voting. Of that amount, clients actually voted on only $812 billion worth of holdings. That means asset managers exercised voting control over roughly 89% of client assets. This gives them extraordinary influence over corporate governance without actually owning the underlying assets. They can effectively guide corporate decision-making through their voting power, influencing everything from executive compensation to strategic direction. The second apex predator in this financial structure is the banking system, led by institutions like JP Morgan Chase. The banks want to maintain the current system as much as possible, but their primary concern now is avoiding what they call the privatization of money. At the recent Davos meeting, central bankers explicitly identified this as their top threat. They're concerned that private payment systems, cryptocurrency, and tokenized assets could route around traditional banking infrastructure, diminishing their control over money flows. Central bank digital currencies are being explored as a way to preserve the role of public money in an increasingly digital economy, improve payment efficiency, and ensure monetary transmission remains effective even as private digital payment systems expand. The competition here is real and measurable. Cryptocurrency markets have grown from a niche experiment 15 years ago into a multi-trillion-dollar asset class, with substantial trading activity across spot, derivatives, and on-chain settlement systems, even if headline volume figures often overstate real economic usage. The crypto lobby represents a genuine challenge to traditional banking because it offers superior technology and potentially higher returns for consumers. The CEO of Coinbase, Brian Armstrong, has been explicit about this competitive advantage, arguing that Americans should earn higher returns on their money and that banks should have to compete on a level playing field. The numbers support this argument. While bank deposit rates have risen in the recent high interest rate environment, the long-term concern for banks is structural rather than cyclical. Digital asset platforms and tokenized financial products can, under certain conditions, offer higher nominal returns, but those returns come with materially higher risk and are not comparable to insured bank deposits. If regulatory frameworks allowed fair competition, traditional banks would lose deposits to higher-yielding alternatives. The second power group consists of sovereign nations, particularly those with nuclear capabilities. These are countries that view globalization as a threat to their control and are willing to sacrifice economic efficiency for political independence. Russia exemplifies this approach. Despite economic sanctions that reduced their GDP and limited access to international markets, they've maintained control over their energy resources and strategic industries. Their trade volume with China increased by over 30% in recent years, demonstrating the viability of alternative economic relationships. China follows a similar model, prioritizing state control over access to Western capital markets. Their Belt and Road Initiative has committed over $1 trillion to infrastructure projects across 60 countries, creating alternative economic relationships that bypass Western financial institutions. Even smaller nations are pursuing sovereignty strategies. Countries like Hungary and Poland have resisted certain European Union policies despite economic pressure, showing that political independence can outweigh economic optimization for many populations. The third group consists of technologists and technocrats who don't particularly care about national boundaries or political systems. They focus on efficiency, scale, and network effects. Their power comes from controlling the infrastructure that increasingly runs everything. Major technology companies have market capitalizations exceeding the GDP of most countries. Apple alone is worth over $3 trillion, larger than the economies of most nations. These companies can work with any political system as long as they receive funding, data access, and regulatory permission. As globalization fragments, technology becomes even more important because it can transcend physical borders. Software, data flows, and digital services don't respect traditional geographic boundaries, giving tech companies unique leverage in any new world order. The fourth group is the military-industrial complex, which serves as the enforcement mechanism for whatever system emerges. Defense contractors like Lockheed Martin, Boeing, and Raytheon generate hundreds of billions in annual revenue by providing the tools to enforce political arrangements. However, this group is somewhat subordinate to financial power because defense spending ultimately depends on capital allocation decisions made by governments that are themselves influenced by financial institutions. Before moving forward, if this video made you stop and think, then the conversation doesn't end here. Leave a comment below and tell me what topic you want us to go deeper into next. This channel exists to break down what most people are never told, and your questions shape what comes next. If you want to understand these shifts before they become obvious to everyone else, make sure you subscribe, like this video, and turn on notifications, because what's coming won't be explained on the evening news, but it will be explained here. Now that we understand the players, what does each group actually want in this new arrangement? The asset managers want a world where capital can move freely regardless of political fragmentation. Their solution is tokenization and fractionalization of assets. Larry Fink of BlackRock has spoken extensively about putting stocks, bonds, real estate, and commodities on blockchain infrastructure to enable instant global trading. This would allow them to maintain control over asset flows even if countries implement different currencies or regulatory systems. The blockchain provides a neutral infrastructure that transcends national boundaries, while giving asset managers comprehensive visibility into all transactions. The banks want to avoid being disintermediated by private money systems. Their strategy focuses on central bank digital currencies that would preserve their role in the financial system. They're particularly concerned about corporate-issued digital currencies that might pay higher interest rates than traditional bank deposits. If large corporations were eventually allowed to issue widely accepted digital liabilities offering competitive yields, this would challenge traditional bank funding models, particularly their reliance on stable, low-cost deposits. This represents an existential threat to traditional banking business models that depend on cheap deposits. The crypto lobby wants regulatory frameworks that allow fair competition with traditional finance. They argue that if Americans could choose between bank deposits earning minimal interest and cryptocurrency protocols offering higher returns, they should have that choice. The sovereigns want control over their domestic resources and industries, even if that means slower economic growth. They are willing to trade market efficiency for political independence and are actively building alternative economic relationships that don't depend on Western institutions. Russia's recent announcement that they want to participate in peace negotiations and contribute funding demonstrates their desire for a seat at the table in any new arrangement. They're not trying to destroy the system, they want to be included in it on different terms. The technologists want access to government contracts, data, and funding sources. In return, they'll develop whatever tools the dominant power structure requires, whether that's digital identity systems, social credit scoring, or automated enforcement mechanisms. The military-industrial complex wants to maintain defense spending levels regardless of which political arrangement emerges. Their business model depends on sustained instability that justifies continued investment in military capabilities. Here's what this means for the average person. We're not heading toward World War III because the cost-benefit analysis doesn't work for any major power. Instead, we're likely to see continued economic fragmentation, with different regions developing their own financial systems, currencies, and trade relationships. The United States will probably maintain technological and military advantages while losing some economic dominance. The dollar will remain important, but won't have the monopoly position it's held since 1971. Other currencies and payment systems will handle increasing portions of global trade. China will likely control manufacturing and infrastructure development across much of Asia, Africa, and parts of South America through continued Belt and Road expansion. Europe will probably focus on regional integration while developing more independent energy and defense capabilities. Russia will maintain control over vast natural resources and energy exports while building stronger economic ties with non-Western countries. Smaller nations will have more options for economic partnerships and won't be forced to choose sides as strictly as during the Cold War. For individuals, this transition creates both opportunities and challenges. Those who understand the shifting landscape can position themselves to benefit from new economic arrangements. Cryptocurrency and blockchain technologies will likely play larger roles in the global financial system. Companies that can operate across different political and economic systems will have advantages. However, the transition period involves significant uncertainty and volatility. Traditional retirement planning assumptions may not hold if the dollar loses its reserve currency status. Real estate values could shift dramatically based on changing migration patterns in economic centers. The key insight is that we're not witnessing random chaos or unpredictable events. This is a systematic restructuring of global power relationships based on changing economic realities and technological capabilities. The old system worked when the United States had overwhelming military and economic advantages. Those advantages still exist, but have diminished relative to other powers. What we're seeing in current events, from trade disputes to territorial claims to sanctions and counter-sanctions, represents negotiating positions in this larger restructuring. Countries are establishing their relative power and influence in whatever arrangement emerges. The financial markets reflect this uncertainty. Traditional asset correlations have broken down as investors try to position for unknown future scenarios. Commodity prices fluctuate based on geopolitical developments because supply chains and trade relationships are being renegotiated. Technology companies command premium valuations because they're seen as adaptable to different political systems. Cryptocurrency markets swing wildly as investors try to determine which digital assets will thrive in a multipolar world. The most important point is that this transition was probably inevitable. The post-World War II system was designed for a world where the United States had unique capabilities that no longer exist exclusively. Other countries have developed their own technological, military, and economic capacity. Rather than trying to maintain an unsustainable arrangement through increasingly expensive enforcement, the major powers are negotiating a new division of global responsibilities and influence. This process involves significant posturing and brinkmanship. But the ultimate goal is establishing stable long-term arrangements that reflect current realities rather than historical advantages. The specific details remain uncertain, but the broad direction is clear. We're moving from a unipolar world dominated by a single power to a multipolar world where several major players control different aspects of the global system. Understanding these dynamics helps explain why traditional political and economic analysis often seems inadequate for current events. We're not just seeing policy disputes or market corrections. We're witnessing the emergence of fundamentally different global structures that will define the next several decades. The winners in this transition will be those who can adapt to changing circumstances, rather than trying to preserve arrangements that no longer reflect underlying realities. The losers will be those who assume the old system will continue indefinitely despite mounting evidence of systematic change. This isn't about predicting the future with certainty. It's about recognizing the forces driving change so you can make informed decisions about everything from career choices to investment strategies to where you want to live and raise your family. The New World Order isn't some distant theoretical possibility. It's happening right now, shaped by verifiable economic trends, measurable financial flows, and documented political developments. The question isn't whether this transition will occur, but how quickly it will unfold and what the final arrangements will look like. Those who understand these dynamics early will be better positioned to navigate the opportunities and challenges ahead. Those who ignore them or assume they're temporary disruptions may find themselves unprepared for the fundamental changes already underway. This is just one piece of the bigger picture. Subscribe if you want to understand the full context and how to better protect yourself in uncertain times. And the video on screen takes this story one step further.